Okay, so one thing is I've been talking a lot to Chat GPT about risk management, and we're going to talk about that. But I wanted to get back to making the trade journal, and I need to redo this because this is for December, and I want to make one for February coming up. So that's what's new. We're going to have to make a copy and make this like the February trade journal. So that's like right around the corner. And then trade plan, we got to start making a copy and put it on this 31st, yeah, 31st trade plan of January 31st. We did a few changes and alterations. One is fading criteria, being more specific on if we're gonna go counter trend, what are our expectations, and this is in priority of most important to least important. So 4-hour market structure break is something we had today. Right there, we had a retest resumption, broke around like 2 a.m. or 4 a.m. and then retest around 6 a.m. all the way until like lunchtime. We had a resumption down, so that confirmed like a more high probable reversal. And then Oasis Trading Suite trail flipping red, so we could see on the 1 hour. So on the 1 hour, right here, it flipped red, and we could see that the trail started, the price has started to take back its gains that it made. And that's kind of what we want to see, and that's why that's number 2, because like these are more lagging in terms of showing a more of a promise of a reversal. And then the DBT Momo having yellow stripe at the 12-hour and 8-hour. So this yellow stripe came on roughly at the open on Sunday, which is, I don't know, like 8 p.m. on Sunday. And that was something that was really early, but we had to get 2 stripes. But yeah, it was still nice to know that if we had 2 yellow stripes for a possible top signal. And then daily and weekly open both near resistance and price below, so that occurred as well. If we move here on the 8-hour here, we started a new day, but before this bar came in, both the daily and the weekly open were right here, and price opened below and it was resistance, and it came down. And before that, last week, the weekly and daily opens were down here, supporting the price until it got below. And then the bounce band still connected to the 1 hour upside. So going back to this one, whenever it was Friday, we were still connected on the bounce band to the gray band to the green band, and that was a no-no to try to fade. That would be too early, and you're just better off saving your breath until we disconnect here. And then also it happens to go in line with the 1 hour trail as well. So we updated the fading criteria of just what we're looking for in the trade plan, just being more specific and allowing less errors to kind of slip under our radar. And then we changed the entry signals that we're looking for. And then we also changed the sizing and the risk management and how much of the position size we'll have, the risk to reward ratio we'll have with each entry event, and what's allowable. And we use our conversation with Chat GPT to make some of these alterations. So a lot of this chat was just about risk of ruin math models, which led us to the Kelly criterion. The Kelly criterion was made famous in when the MIT people went to go gamble with blackjack, and they used the Kelly criterion based upon how much they could risk per blackjack hand, and that was more of an aggressive strategy before hitting risk of ruin. So risk of ruin is very famous for like the math and the math around that. So the reason for the big push for risk management is kind of I've view trading like weight loss. So according to examine.com, that weight loss is due to calorie deficit, and calorie deficit could be due to your diet or your exercise, but overall it says that the link for weight loss is calorie deficit. So risk management is just like that in weight loss. Like if you were to swap the two, risk management is the main cause for success and profit, and that's what you're doing when you trade, is you manage risk, and it comes down to risk reward. And then when it comes down to how people get the win rate and how they win, everybody has got their own kind of style. Southwest Beach diet, Atkins diet, fruitarian, vegan, vegetarian. So there's many different styles on how to win at the game of weight loss, but at the core of it is calorie deficit. And that's the same thing with trading. At the heart of it is risk management. There's many different ways to trade, many styles of trading. You got your mean reversion trading, you got your trend trading, you got those who fade, you got those who do position trading, scalp or swing trade. There's many different ways. Options trade, the ones that play when the market doesn't move. But at the heart of it, we need a way to prevent risk of ruin and manage risk well. So we came across many math models, and that's through this conversation here. So there was 6 math models for risk management. Kelly criterion, which has to do with that famous movie or book, Beat the Dealer, and they figured out what was an aggressive but growth strategy for risking your each hand. And then martingale model, which is like a gambler's kind, assumes the probability of winning and losing is constant, which it isn't. Fixed fractional model, which is kind of what most traders are told, which is like 1% per trade. Fixed ratio model involves a fixed ratio of total capital in each trade regardless of the outcome. This one is a fixed fraction of the total capital on each trade regardless of the outcome. So this one's the fixed fraction. Fixed ratio is the fixed ratio of total capital. They're somewhat similar. Anti-martingale model is instead of the size increase after each loss to recoup the losses, this one is decreased after each loss and increased with each win. And then modified Kelly criterion adjusts risk to take in order to account for volatility and other factors. Basically, it's a smaller, instead of like the Kelly criterion being aggressive, that's what it's really known for. It's just its optimal, most aggressive growth, position sizing, for like a high expected win rate. Modified Kelly criterion notches that back by like a third. And then we asked basically what would be the most conservative, and it said that in general, the fixed fractional model and the fixed modified Kelly criterion are considered to be more conservative. So I asked for an example later, but basically we're just going to use the fixed fractional until we can do the modified Kelly criterion. And in order to do the modified Kelly criterion, we got to have more of a big data pool of our win rate. So we need to collect data on our win rate, and I'm going to start tracking on the trade plan the win rate of the 15-minute market structure break trades the win rate of the 4-hour market structure break trades and the 12-hour market structure break trades. And that's set right here. In progress for tracking win rate. And that's going to help us scale our the risk that we can take per trade. And it suggested, I asked for basically how to name the priority of the three, which is so making winners big and losers small. What would you prioritize in importance from first to last? Win rate, risk to reward ratio, or risk per trade? And it said basically risk per trade or risk management was the top one. It's the first number one priority in making winners big and losers small. Basically having a slow position, a low position size, and like a smaller stop loss. But for something that's kind of volatile, and for exchange for a higher win rate, we're expanding the stop loss. Something that's less volatile, we could narrow the stop loss, but the thing is, I don't think we've reached that point yet. Mostly, if I were to do a bounce band on, I think it's here, on the weekly, we're disconnected. So anytime we're like close to disconnected on the daily or weekly, we're more than normal volatile. But whenever we start trending, I can start tightening up the stop loss to where it's not so wide, like a 30 tick stop loss. Instead, we could use a 15. But the thing is we're not there yet. And then risk to reward ratio is the second priority, and that's something that I modified in the trade plan with each conditional trade entry, which is the 4-to-1 has a 2 micro split strategy trade, a 2-to-1 scalp, and a 3-to-1 swing, and then the 12-hour has a 4-to-1 swing and a 2-to-1 scalp at the same time on the entry. And then the 15-minute market structure break is half the size, and it only focuses on 2-to-1. So then it has a higher chance of win rate and smaller chance of loss, and overall better improved chances against risk of ruin. And then we will be tracking the win rate. It's not as important, but when it comes to scaling, I say it's important for adjusting your position size as you go forward. But overall, the entries should not change overall. But I think if we put in the trade plan about the stop loss, it would have to be, I guess it is related to risk management, adjusted by Baus band's efficiency on daily and weekly connectivity. So if it's if the bands are connected, smaller stop loss, like 15 ticks, could be used. If the bands are disconnected, the stop loss is doubled to 30 ticks. So that's pretty much it. What I've been learning recently. One is kind of setting a stricter fading criteria for a confirmation, or just slowing things down, because a lot of my stuff are just highly leading. So my institutional bias indicator, the timing solutions, they're very leading, and then also the DPT Momo is leading as well. and it just kind of takes time for things to process. And even though I day trade, it's still slow. If that even makes sense. But that's kind of just the alterations I'm making to my trade plan for the day, including these things to remind myself just kind of how far I've come and what I've learned, and to remember these things. And I'm going to be including videos on just kind of new case studies I'm working on. Technically, these additions are a case study in itself because I'm going to be tracking the win rate of these market structure breaks and this 2 to 1, 3 to 1, 2 to 1, 4 to 1 kind of split strategy. See if it's actually increasing the win rate or even the risk to reward ratio. We want a success to go with the risk to reward and the win rate. Basically repeated myself there, but yeah, we're shooting for just the synergy of those components for making the winners big and the losers small, and going from here. There's nothing else but to apply it. And right now I'm getting excited just because most of my stuff has been automated. A lot of the things are just discretionary of just when I set things up and just my judgment of my analysis. And I love how it's like that. And for the most part, the main work and time that I have to give it is specifically just staying awake at the right periods to where I could turn on the bot or leave it off. And that's basically it for just kind of the updates to the trade plan and the risk management and the overall strategy.